All right, good morning, everybody, and welcome to this session, the first masterclass dealing with the topic of financial profit versus mutual profit. My name is Zafeer Nagdee, and I'm an MBA student here at the Side Business School, and I'm very happy to be your host for this morning's session. Joining me on stage, of course, are three absolute experts in their fields, who I will introduce shortly, and will also help us unpack this notion of mutual profit. Conventional accounting theory tells us that accounting depicts economic reality through the language it uses in the form of assets, income, expenses, liabilities, etc. What we are hoping to unpack today are new measures of economic profit, very much drawing on the messages that were espoused this morning, on how we can transition away from a triple bottom line, where we have traditionally dealt with environmental awareness, social justice, and economic prosperity, into a single profit line in an attempt to promote mutuality in business. So through the use of language, through the use of conventional accounting and finance principles, what we'll be exploring this morning is how we can start developing a new language to not only depict economic reality, but to create that economic reality as well. So ladies and gentlemen, I'd like to introduce our three guest speakers. This is quite cool because for the first time in my career, I get to say that our first guest speaker needs no introduction. I can genuinely say that for the first time. So everybody knows Professor Colin Meyer. I will just give a brief introduction to build some context for where we're headed with the discussion. So of course, Professor Colin Meyer was the first professor here at the Side Business School back then in 1994. The Peter Moores Dean of the Business School between 2008 and 2011, and the first director of the Oxford Financial Research Center between 1998 and 2005. He was a Harkness Fellow at Harvard Business School, a Hublot Norman Fellow at the Bank of England, the first Leo Goldschmidt Visiting Professor of Corporate Governance at the Savoy Business School in Brussels, and has had visiting professorships at Columbia, MIT, and Stanford universities. Professor Colin Meyer was also the chairman of Oxera Limited between 1998 and 2010, and assisted in building the company into what it is now, which is one of the largest independent economics consultancies in Europe. He is a director of the energy modeling company, Aurora Energy Research. He advises companies, governments, international agencies, and regulators around the world. He also leads the British Academy inquiry into the future of the corporation, and is very well known for his authorship of the book Firm Commitment, Why the Corporation is Failing Us and How to Restore Trust in It. And in his forthcoming book, Prosperity, Better Business Makes Better Good, will be published later this year through the Oxford University Press. So let's put our hands together for Professor Colin Meyer. Professor can join us on stage. Thank you.
Thank you very much, Zafeer, for the no introduction. I started off this morning by saying what we're trying to do in the course of this forum is to think about how do we move from a model, conventional model of the firm that puts profit at its center, to one that recognizes the real intrinsic purposes of companies in promoting the interests of consumers, of society, etc., and embraces the engagement of all the various parties to the firm in achieving that. And I made the point that the economics of mutuality is not about charity or philanthropy, it's about business, about the success of business, about the profitability of business. And we heard just now from Eleanor Brown about how incentives determine beliefs. Profit and the measurement of profit is then critical to the success of trying to shift the prevailing view of the right model of business. Now, we all know what we mean by profit. Profit is revenue minus operating costs minus the capital costs of a business where those capital costs include the servicing of the capital and the depreciation of that capital. But what the economics of mutuality brings out is that in thinking about that definition of profit, we have to recognize what the various inputs are into delivering the outcome of the firm. And traditionally, when we think about it in relation to conventional accounts, we do so in terms of essentially two types of capital. Material capital, buildings, plants, machinery, etc., and financial capital, cash, holdings of bonds and equities, etc. And we regard the balance sheet of a company as comprising this: the assets of physical capital and financial capital on the one side, and the liabilities to the creditors of the company that, when subtracted off, give us the net worth of the firm. But what we now recognize when we think about the contribution of all the various parties to the firm, that critical to the success of the company is not just the assets of physical assets and financial assets. What are also critical are the human assets, the social assets, and the natural assets of the firm. And the importance of this in terms of thinking about the profit of a company is that we have to recognize those as capitals of the firm, assets of the firm, equivalent to those of physical capital and financial capital. And that importance stems from the fact that if you don't recognize them as contributing to the performance of the firm over the long run, you don't recognize them as investments. And that actually the balance sheet of a company should look like this in terms of recognizing those forms of capital, of human capital, social capital, and natural capital, alongside the material capital and financial capital. And there are two reasons why this is critically important. The first is in thinking about the profit of the company and the subtraction of the operating costs and the capital costs from the revenue. If you don't recognize these as investments as against current expenditures, you fail to recognize the fact that actually your profits are not diminished by the full expenditure. These are investments whose costs should be spread like any investment over the life of those assets. So you're understating the profit of the company by not recognizing them as capitals of the firm. And the second failure is that you're not only understating the profit, you are subsequently overstating the profit if you do not invest to sustain and maintain those forms of capital in exactly the same way as you're overstating your profits if you don't sustain and maintain your material capital. So here's the traditional measure of profit of a firm. Revenue minus operating costs minus the material capital depreciation gives you the financial profit of the firm. But that's wrong on two scores. First of all, it does not recognize that it's not only the material capital that you have to depreciate, but it's also the natural capital assets, the social capital assets, and also the human capital. And the second failure is to treat investment expenditures as operating expenditures, when in fact they are not operating costs of the firm. So this mutual profit of firms differs in these two respects from the traditional financial profit of the firm. And I want to illustrate its significance in relation to one of those forms of capital, natural capital. And I want to illustrate how in practice one can operationalize this in such a form as to derive a true mutual notion of profit. What it involves is essentially exactly what one does with any other type of capital. First of all, one creates an inventory. What is the stock of natural capital that a company has got? Measured in terms of physical notions of how much natural capital they've got, the area of natural capital, the composition of that natural capital, and the state, the quality of that natural capital. And then one looks at the various metrics by which one can evaluate that natural capital in terms of the natural resources that the company has available to it, and also in terms of the outputs that those resources create. Because that then allows you to target that form of capital as a resource available to enhance the performance of the firm. And those metrics allow you to think about the benefits that those resources create for the firm in exactly the same way as its buildings and its plant and machinery are resources that create benefits for the firm. And it then focuses the firm on thinking about investing in those resources and promoting those resources and enhancing them, so that you then derive a natural capital balance sheet exactly equivalent to the balance sheet that you would have for physical assets and financial assets, which then feed in to the assets of the firm. And so those metrics that I was just describing come in the form of thinking about natural capital as a resource and a source of benefits for people and the firm. So take 3 examples. Take, for example, water. How much water does a company have as access to it as a resource? Not just how much of it, what's the quality of that? To what extent is it pure water? Is it contaminated water? And then think about the outputs that it can generate in terms of providing a source of input into beverage companies as a way of creating outputs for water utilities, as a way of creating recreational facilities. And then think about another, soil, and not just the quantity and quality of soil, but the extent to which that soil is in good condition, has high carbon content to it. And then think about the outputs from that in terms of the plants and the food that it creates, and those outputs as benefits to companies. Or think about the woodlands and trees, again in terms of the quantity and the biodiversity of them as resources, but then think about them as a source of timber that can be sold, as a source of energy, as a source of recreation that can generate revenues for companies as well. And to think about this as a resource that should then be invested in. Here, for example, is a company, utility company, thinking about investing in purifying its water resources and seeking to move from a position where a quarter of the water resources it has are pure to 3/4 over a period of years by investing. So what this illustrates is that once one thinks in terms of the objective of the company, the purpose of the company, and these various forms of resources, natural capital, human capital, social capital, as resources available for enhancing the performance of the firm, it has profound implications for thinking about the balance sheets of companies, what should be treated as investment and assets, and also for the profit and loss statements of companies. And it's therefore a mechanism for aligning incentives with the objectives of companies. And what I've just described in terms of natural capital resources applies equally to these other forms of capital, human capital, social capital, intellectual capital, where one can use exactly the same framework to really promote the mutuality of business. Thank you.
Thank you very much, Professor Colin. As an accountant myself, I'm always quite cautious to use the word accounting and fascinating in the same sentence. But I think that was quite fascinating, and I'm quite interested to hear the kind of questions that will come from our Q&A in a few minutes' time. But up next, I would like to call upon our next guest speaker, Mr. Barend van Bergen, who is a partner at E&Y. Barend has over 20 years of experience in advising companies on measuring, managing, and communicating their values, and how they create value, particularly for investors and the broader stakeholder group. He is the author and EY Global Ambassador and Global Methodology Lead, working with the Coalition for Inclusive Capitalism on a proof of concept to encourage, measure, and demonstrate long-term value creation. This 18-month initiative involves more than 30 global companies, including some of the largest fund managers and asset owners who represent $25 trillion in assets under their management. So prior to joining EY, Barend led the development and global rollout of the KPMG True Value methodology between 2012 and 2016, which was applied to over 10 sectors. Barend holds a degree in engineering from the Eindhoven University of Technology and is a part-time visiting fellow at the Yale School of Management. So ladies and gentlemen, please join me in welcoming up to the podium, Mr. Barend van Bergen.
Good morning. Good morning. I can sit here as well?
Yeah, that's good.
Okay. I don't have a lot of slides, so I might as well sit here. So thank you very much for having me this morning on a very, very topical topic on trust. I really like some of the opening remarks. I was really glad that the Big Four and the professional service firms were not singled out in that ranking. Because at the moment, our industry over the last couple of years is at the heart of, a debate around trust, basically. But I guess we're part, of business, which is kind of tumbling at that ranking. Again, delighted to be here, and thank you, Bruno and Mars, for your leadership in this area. When I first met Bruno, it was fascinating to hear that somebody 10 years, not somebody, but a shareholder, asked that question 10 years ago from a completely different point of departure than I guess a lot of the other companies and discussions have taken shape. So what is the right level of financial profitability? So I spent a bit more time in reading the books and the publications. It's really fascinating to see a privately owned company going in that journey, and it's great that Mars is opening up and maybe sharing their lessons. Also very glad to be here at the Said Business School. I know there's a lot of relationships between the business school and EY. So I didn't make partner in EY, but in KPMG. But all our new partners go to a 2-year leadership track here. And currently we're discussing that, as a standard part of that curriculum, we need to have, some of the economics of mutuality to shape our, new leaders. So looking forward also to work on that. So I was asked in 6 to 10 minutes, and there's a countdown clock, so I'll try to keep time to talk about 4 issues: accounting, natural capital, social capital, non-financial metrics, and integrated profit and loss statements. So let me just, as a practitioner, make some opening remarks about those 4 topics. And as much as there's nothing more practical than a good theory, I could only make those practical comments as a practitioner, having worked for the last 20 years at the intersection between business and society. On accounting, so I think on those 4 topics, the first topic I see a bit as the problem, and the latter 3 as maybe part of the solution. So talking about accounting, we could have a full day about accounting. What I would like to say is that I think also the accounting profession has maybe failed us. The institutions, the ISB and some of the other institutions have failed us. It took us 100 years, well, even more than 100 years to get to a set of accounting rules, IFRS and US GAAP. I think it's very positive that now in, let's say 5 years, we have a set of rules for natural capital protocol and social capital protocol. But at the heart, we need also the accounting profession to step up We are trapped with accounting rules in the past. So if you have some time as a student, I would recommend the book of Barend. It's called The End of Accounting, which was a very stimulating title for a Big Four firm, which basically describes that in the field of public policy, accounting is one of the very few fields that has literally see very, very few innovation because of a whole lot of reasons. So I think we're kind of trapped with a set of accounting rules that are no longer fit for purpose. And I think the IASB, and we are talking to them, should step up. A couple of years ago, they said for the next 12 years, intangible, long-term value, natural capital, social capital are not on the agenda. There are some other things that we need to do. I think that is shifting, and it should shift. Then on natural capital protocol and social protocol, I think it's a very important movement. Again, it was created in a couple of years by multi-stakeholders, so not by the accounting institutions, but by a consortium of business associations, civil society, NGOs, and a few others. So I think it's been very exciting. I've been involved in both the natural capital process, very complex process with, again, multi-actors, but it's now really applied, tested, road tested around the world. So that's really important. Social capital protocol, I've also been involved in that one. It's a bit more difficult, obviously, because social topics tend to be much more kind of jurisdiction dependent, much broader range, but also I think it's important to try to get to some standards around that. So I think that's very encouraging, and ultimately that has to find its way into the accounting rules in IFRS, US GAAP, and what have you. Then on non-financial metrics, again, I also think that could be part of the solution. The reason for EY to be involved in this is that we want to be relevant. We are being disrupted as an industry, as all sectors and industries. So what would happen if Google would do an audit? There's audit mandatory rotation. So that started some of our thinking. So from a slightly different starting point. But we started thinking about disruption, about audit mandate rotation. We saw and we see the rise of intangibles. So we no longer audit. In the past, we audited 80% of organizational value, the physical and financial assets of the companies. In certain industry, we only audit 10%. So if we want to stay relevant, if you want to have a job, some of you in the future, we better get to grips with auditing and assuring the other parts, the other value drivers. To do that, that's why we got engaged together with the Coalition for Inclusive Capitalism and work on a proof of concept with 33 companies along the investment value chain. There's a lot of initiatives out there. What we felt was important to create some innovation outside the system and work with asset owners, managers, and companies and try to innovate and get to a new set of outcome-based metrics, not just for ESG, natural capital, and social capital protocol, but for all the intangibles, so brand, IP, etc. So it's a huge undertaking, and it's very fascinating to do that with a group of 30 companies. I think it's really encouraging also to see the investor community stepping up. Many people talk about the letter of Larry Fink, BlackRock, Bill McNabb, Vanguard, Martin Lipton. So I think there's a momentum there also from the investor community. Huge problems, agency problems, conflicts of interest around that. So happy to discuss a bit more here or offline. So outcome-based metrics in the area of social natural capital, very important, and we as EY are part of that broader coalition to try to get to some answers. And again, we're very humbled, but this is a very big group of companies, but what we bring to the table is 100 years of measuring and auditing, and we believe that's relevant and we want to play our role. Then finally, on integrated profit and loss statement. That's my favorite topic. As an engineer, I want to measure, and I want to connect the macro with the micro, the enterprise level. And it's absolutely a privilege to work with brave business leaders. So my first integrated profit and loss statement project was in India, working with a company called Ambuja, which was previously privately held and then acquired by Lafarge Holcim, now the biggest cement company in the world. When they asked, after 40 months of work, where we on an asset-based level went to 12 factories, 2 harbors, to create an integrated profit and loss statement, when they asked, who else published this? We had to say nobody. And it was a very brave, I think, business decision to say, okay, we're going to push through after a lot of advice that we shouldn't from the lawyers, from the North American Legal Council, etc. This company pushed through and published, to my knowledge, the first ever integrated profit and loss statement. And ever since, we've seen quite a few others in at least 10 sectors that I've worked in. And the Impact Valuation Roundtable, which is another initiative of 30 companies, estimate there's 500 companies now actively, either on the back of an envelope or publicly out there, publishing or working on an integrated profit and loss statement. So to conclude, I think measuring long-term value, including social capital and natural capital, is increasingly important. It will become important, not just because of the company, civil society, but also from the investor community. We hope that the project embankment will catalyze some change, some much-needed change outside the system. And luckily, we see increased sophistication both on an individual and collectively level. And I think the business schools have a very important role to play, but maybe we can leave that for the debate. Thank you.
Thank you very much. I think it was quite refreshing to hear such a bold and candid call for accounting reform, specifically coming out from practice. We usually hear these things in the circles of academia, but for that sort of mindset to have transitioned into practice is really uplifting. Our next guest speaker, Mr. Jacek Szarzynski, is the CFO for Mars Petcare. Sorry about that. Szarzynski's career spans over 18 years across markets, regions, and segments at Mars, where he joined in 1994. He also worked as a business planning specialist in Mars Poland. He served in a number of market segments and a number of roles before becoming the regional CFO for Mars Scandinavia in 2002. He went on to become CFO of Mars Drinks, Mars Food, before joining Petcare in 2016. Interesting to note that the Petcare segment is evolving from pet nutrition into pet health, preventative healthcare from nutrition, using digital and technology platforms to create a more holistic world inspired by Mars' vision to make a better world for pets. So a lot of context with regards to the capitals that we've been speaking about. Let's put our hands together for Mr. Jacek Szarzynski.
Thank you very much for inviting me, especially Bruno. It's an honor to be here with such a great guest. I must tell you that I was really humbled by the speech of the two ladies, Bharati and Eleanor. I think I took a picture of the two of them and sent to my daughter, who's just about to start business school in Bocconi University in Milan. And I said, I see you one day on stage on institution like this, talking about what's important for the business. I also totally agree with what you said, Bruno, that it's our generation who have to find the answer for the question, what's really first, and what's the approach towards profit. I also think that finance has fiduciary responsibility to play a big role in partnering with the business. I want to talk mostly about what we do in Petcare, but before I do so, I would like to tell you what Mars as a company believes in how value is created. Mars is a company, Jean-Christophe said, it's no coincidence that it has been in existence over 100 years. We've made many mistakes and many successes. We've grown through financial crisis. Actually, financial crisis made us always stronger. We do believe, not only because it's the principled way to lead the business, but we do believe that the companies that lead the business in a purposeful way will survive longer. It's a matter of how you play and what you believe in. And as many companies, we have our principles. We have 5 principles of quality, responsibility, freedom, mutuality, and efficiency. 2 of them stand out very clearly, which are belief in freedom, especially in financial freedom, and believe in mutuality. My colleagues before talked about mutuality, and when it started over 50, 60 years ago. But the way we look at value is a combination of two things. We believe that company, in order to survive, has to be based on a financial and sound financial basis. It has to operate with a portfolio which is good for people, which is good for consumers, and in our case, for animals that we serve. We also believe that the second part of the equation is very important, is to be trusted internally and externally, and to have impact which is at least neutral, if not positive. Bruno talked about social, natural, financial, human capital. We try to put these things together with the help of catalysts and external institutions to try to see what it matters and how to do this in a financial way. I chose two examples from Petcare. Mars, as you know, is more known for a candy company. Not so many people know that actually Petcare division is twice as big as the candy business today. But we started 8 years ago in the UK from a very basic premises, believing that we have a responsibility to feed animals from what used to be table scraps 8 years ago, and we went into manufactured pet food. We then entered into individualized nutrition with the Royal Canin brand, and then less than 20 years ago, we started looking into space of veterinary as a natural adjacency to our mission. Our mission in Petcare is to create a better world for pets, because we believe that pets make us human better. And by elevating pets' role in the society, we claim that we can make life of humans better. I chose the example of veterinary. 8 years ago, our business was less than a few $100 million in veterinary space. We had few clinics and just an equity investment with a clinic called Banfield. A few years later, we are operating in North America market, having more than 2,000 hospitals, a laboratory business, and we are one of the biggest operators, and we are the biggest employer for veterinarians globally. Because we employ the biggest number of veterinarians, we believe that we have responsibility not only to address the quality of medicine in the veterinary space, but also create better world for vets. Some of you who live in America might know that Americans are not as blessed with education, which is mostly free as it is in Europe. And most of our veterinarians, who we have thousands of, start education with big debt. And when they graduate, on average, they have $150,000 of student debt. We are mostly employing women. Veterinary business is a women business. 85% of them will break even at the age of 62, and 15% of them who are men will break even at the age of 57. This created a big challenge to us. And frankly speaking, we did not look at financial return on this, but we have created something that we call Student Debt Relief Program, which allows us to leverage Mars financial standing with our relationship with financial institutions, putting the cost on the P&L, not as a cost, as an investment to retain the best doctors, which in turn allows us to alleviate student debt by 50% in less than 10 years. We do this not to have the doctors stay with us. Doctors don't need to stay with us. If they choose to leave, they can leave us. We believe it's important because we have to address broken industry. And we have to invest in the industry, in the veterinary education, in order to be able to supply our growing business in Europe and Latin America, in China, 1-2 years from now. We also believe that despite the fact that we only have clinics in America and Canada, We have to take a position in how doctors are educated. So we invested a lot of money in veterinary education, in veterinary university. We are streaming live operations for doctors around the world and take no money for this. We are launching veterinary university available everywhere to everybody who is practicing the medicine. The next example I wanted to bring to you is Royal Canin. Royal Canin is the division of Mars, which is selling individualized nutrition to dogs and cats. The mission of this business is animal first, animal before anything else. And knowledge and respect for animal is everything that matters. Despite the fact that we have one brand, Royal Canin, we are sold in 3 different, completely independently run channels. One which we call Breeders, which is professional channel. Another one which is called Specialty Pet Trade, so specialty pet stores. And another one which is called Veterinarians. These 3 channels sell completely different diets to completely different groups. Veterinary channel is selling nutrition for animals that need veterinary treatment and address all the needs of breed, size, or developmental needs. We have therapeutical food. We have food which is sold for animals that needs hospitalization. We also sell instant nutrition for babies. We sell to 200,000 plus veterinarians across the globe who prescribe our products. And the business which I want to talk about is breeders. In breeders are very specific type of people who love their animals and breed different animals, not necessarily for money, but because they love animals. Breeders channel, we don't measure profitability because we make no money. But we believe that the first stage of life of animals is as important as in human life. That's why Danone, for example, program of first 1,000 days, which is subscribing to WHO organization, is very similar to what we do in animal space. And the last example I want to bring with you is veterinarians. Veterinarians love animals. They not necessarily like humans a lot, and they are not very good business people. The way Royal Canin has rolled out global operations from being pure French company, now operating in more than 80 countries, is very simple. We have selected veterinarians using social cohesion and their adaptability and love for animals, and we have looked at them and worked with them whether any of them would want to become a business person. And we selected 1 or 2 or 5 veterinarians who loved what they did and wanted to create their business, and we helped them set up the business in each country they've been operating. And 18 years after acquisition of Royal Canin, we operate in as many countries as I told you, where mostly veterinarians are running the business that became, Mars operations at the end of the day. So with this, I'll hand over to you, yes? Thank you.
Thanks, Jacek. I think it was quite insightful to see how the Petcare ecosystem is so interdependent on all of the different elements. The MBA students recently did an assignment on the Petcare industry where we sort of analyzed these things, and I think if I had those, or if I had these insights then, I would have probably cracked that distinction. But it's all right, we're learning every day, and that's the cool thing about being here at Oxford. So I think we can open up the floor to questions. I think I'll start off with one that was posted on the Slido platform. So please keep in mind that if you don't want to ask the question live, you can post your question on the Slido platform. So I think this first question we can open up to the floor. So in terms of the mutual balance sheet, are human, social, and natural assets owned by the firm or part by the commons? If so, how to then value the firm's share on the balance sheet? I don't know if...
Just an easy question to start with.
Yeah.
I think it's really hard to give one-size-fits-all answer, but when you look at stock and flows, and now you're talking about, obviously, the stocks, the assets, then obviously it depends on the sector, on the jurisdiction, who owns what. I think what you do with the economics of mutuality and integrated profit and loss statement, impact measurement, is just make that more visible and look, upstream, downstream in your own operations. And basically what the Financial Reporting Council in this country calls a conscious forward look, and understand the externalities, so the classical externalities, and basically understand at a very granular level what positive effects, positive externalities and negative externalities you create. So by doing an exercise like that, you get a really detailed view in the positive and negative externalities that are quite close, to ownership. So I think you need to go to a bit of that exercise and understand what are your externalities. So you don't own them, you kind of pass on either the negative or the positive consequences to the wider society. So I think you can only get to the answer to basically apply the theory of the economics of mutuality or some of the other impact measurement evaluation methodology. And for a company, this is really, really hard. Maybe as a last comment. Some of this, impact measurement evaluation is a very practical field. Government has applied this for over a century in welfare economics, where they had to optimize the tax dollar. Do I invest in a road, in a school, in a community? For businesses, this is completely new. So although you can apply some of the welfare economics principles, I think for business, this is a whole new field that's opening up. It's an emerging field, and the accountants and the finance profession have to unlearn and learn, I guess, to understand the externalities along the investment value chain. And then I think you arrive at the answers of who owns what.
I think accounting standards can really help. At the end of the day, it's multiple that pays for the company. And I do believe that there is a strong correlation between current multiples you pay for some companies, with trust they generate, or mistrust, with how they deplete or contribute to natural resources. And at the end of the day, you could imagine the future where you would have an adjusted EBITDA statement that would be used as a multiplier of the company. So at the end of the day, the attractiveness of the companies that would be selected from will be a function of using all sources of capital and rewarding them accordingly. It's very difficult today to prove what is the cost of trust. It's very difficult today to prove what is the cost of investing in doing good. Yeah? But there are companies which are actively looked after and bought by activists just because they are doing good and doing well at the same time. And these two things should never be taken in separation. These two things, doing good and doing well, should always come together in pair. Like Bruno said, there's no double, triple, or quadruple bottom line. There's one bottom line that we have to look at.
So I agree with the two previous panelists that assets vary in terms of the extent to which they are on a particular company's balance sheet. And I want to illustrate this in relation to the example I was giving of natural capital assets. So there are really three forms that they can take. First of all, companies own natural capital assets. They own water resources, they own woodlands, etc. Secondly, if they don't own, then they may be in their supply chain, so that a supplying company or a distribution company may own natural capital assets and utilize those assets in supplying or distributing from the company in question. And thirdly, there are forms of natural capital that companies don't own, aren't necessarily in their supply chain, but where they still have an effect. So, for example, atmospheric contamination, they don't own the atmosphere, but they have an effect on the atmosphere. Now, in each case, the activity of the company impacts on natural capital assets in some form or another. And so, arguably, one should say, well, that should be included in the company's balance sheets and profit and loss statements to give them the right incentives. The argument for that is that we can utilize the structure that I've just described to achieve that. Because in essence, you can create your management accounts in whatever way you like. Now, financial reporting is different from management accounting. Financial reporting has to follow particular accounting standards and all the issues that you were talking about, Barend, in terms of reporting conventions affect what a company has to put into their financial reports. But a company can create its management accounts as it feels is appropriate for achieving the objectives of a company. And it's critical then to think about aligning management accounts with the purpose of the firm. And if it attaches importance to the impact that it's having on natural capital, then it should reflect the effects it's having in its supply chain, on the environment, as well as in its balance sheet. So it can use the management accounts to achieve that. And that is a very powerful way in which it can essentially integrate the entire effect that it's having across its supply chain, distribution chain, and across the externalities in terms of the environment. That is different from saying whether or not it should be in its financial accounts. And the argument for restricting it to just the first component, namely the assets that it actually owns, is that if you include, for example, the assets owned by the supply chain, there'll be a great deal of double counting. So this distinction between thinking about what you can do and where you should report things on your management accounts against your financial accounts is critically important.
Thank you. Do we have any questions from the audience? You can just get a mic going there in front.
Hi, good morning. Is it audible? Hello. Hi, I am Piyush from Mars. I represent India. I'm part of JC team. I have a question to, rather two questions to Professor Colin Mayer. One, the first one is, while one of your slides showed in the asset side of human and social capital, unlike the conventional way of financial measurement where all the assets depreciate, this human capital and social capital normally appreciates if you invest in terms of loyalty, experience, knowledges. This is subject to appreciate. So how to keep an asset which is appreciating in the list of where depreciating assets are conventionally used? And the second question is more related to application of business. While on a startup kind of business, while you're doing a business forecast, how do you forecast these two capitals in particular where you can't project it with the base level of the social and human capital? And second is whether it will appreciate or depreciate, you can't forecast as a startup level. Thank you.
Okay, thank you very much for your question, and it's a very important point. And one thing that I want to emphasize is that this is not about valuation. This is not about valuing natural capital. There's a great deal of work that's done in terms of trying to get valuations of human capital, social capital, and natural capital. And there are projects known as the National Wealth Projects that try to do that, not just for companies, but also for nations. And it's incredibly difficult because you have to project these various metrics that I was just describing in terms of the quality, the quantities, into the future. You have to attach a price to things like trust. You have to discount it at some discount rate to get back to a valuation today. Frankly, it's entirely flaky. I mean, it's not to say it isn't important and it's a valuable exercise to try and do, but it's simply not acceptable from the point of view of accounting standards. Okay? That is not what I'm talking about here. I've described the metrics as being important for thinking about the management of the business, okay, in terms of where a business should be thinking about investing, exactly in line with where it should think about investing in physical capital, in terms of the metrics of the benefits that are thereby derived. But in terms of what is shown on the accounts of the firm, it's literally the same as for physical assets. It's the expenditure. It's the dollars that the company invests. And so what you are putting onto your balance sheet is a financial investment by the company. And it's that you are depreciating. So you're not revaluing the assets simply when there's a change in terms of the appreciation in terms of the assets themselves, any more than you do so for material assets. You are showing them essentially at cost and recording that cost and depreciating that cost in deriving a profit figure that's exactly equivalent to traditional measures of profit. And it's because there is a transfer across from traditional accounting to this mutual accounting that it's potentially such a valuable technique, particularly if you think about it in the managerial accounting context that I was talking about.
Okay, thank you. A lot to talk about. Unfortunately, we seem to have run out of time. The good news is we do have a tea break up next. So if any of the audience members had some burning questions, you're more than welcome to come through and speak to the panelists. I think we're going to break now, and we will reconvene in 20 minutes' time. So thanks very much.